Most people think banks treat everyone the same. You walk in, you open an account, you get a debit card, and that's it. Same lobby, same teller window, same hold times on the phone. But here's what nobody tells you. Behind that lobby, there's a hidden menu. A menu you'll never see on the website. A menu that only gets handed to you once your net worth crosses certain lines. And I'm not talking about some VIP credit card with lounge access. I'm talking about your bank literally changing the way it sees you. Lower interest rates on loans. A personal banker who picks up on the first ring. Access to investments that aren't available to the general public. Even the fees you've been paying for years just quietly disappear. Today, I'm going to walk you through the 3 net worth levels where banks completely flip the script on how they treat you. And I'll tell you exactly what unlocks at each level, so you know what to aim for and what to demand once you get there. Let's start with the reality most people live in. The median net worth of an American household sits around $192,000. That includes home equity, retirement accounts, everything. And when you're in that range or below, the bank sees you as a cost center. That's the honest truth. They charge you monthly fees. They hit you with overdraft penalties. They put you on hold for 45 minutes when something goes wrong. You're profitable to them, but not because they're helping you grow your money. You're profitable because of the fees they charge you. And these fees are not small. In 2024, American consumers paid over $12 billion in overdraft and non-sufficient fund fees alone. And research from the CFPB found that nearly 80% of those charges came from just 9% of accounts. Accounts that typically had only a few $100s in them at any given time. So the people paying the most in fees are the ones who can afford it the least. That's the reality of how banking works at the bottom. But something shifts when your net worth starts climbing. And the first real threshold is $100,000 to $250,000 in investable assets. I'm not talking about total net worth. I'm talking about liquid money. Cash, savings, brokerage accounts, CDs, money markets. The stuff that's actually sitting inside or connected to your banking relationship. When you cross the $100,000 mark, you start showing up on a different radar inside the bank. At Bank of America, for instance, once you have $100,000 in combined balances across your banking and Merrill investment accounts, you hit what they call the Platinum Honors tier. And this is where the math starts to change in your favor. You get a 75% bonus on credit card rewards. So a card earning 1.5% cash back suddenly earns you 2.62% back on every purchase. You get interest rate discounts on mortgages and auto loans. We're talking 0.375% off your home loan rate. On a $400,000 mortgage, that saves you tens of thousands of dollars over the life of the loan. They waive fees on accounts that regular customers pay every month. You even get free stock and ETF trades through Merrill. And it's not just Bank of America. At Chase, once you maintain $150,000 or more in combined deposits and investments, you qualify for Chase Private Client. That unlocks a dedicated banker, someone who knows your accounts, your goals, your situation. You get waived fees on wire transfers and cashier's checks. They give you higher daily ATM withdrawal limits. You get access to JP Morgan investment products. And when you call, you skip the general phone queue entirely. Let me put some math behind this so it sinks in. Say you're a regular Chase customer paying a $12 monthly service fee on your checking account. That's $144 a year gone for nothing. As a private client, That fee vanishes. Now add the savings on wire transfers. A single domestic wire can cost $25 to $35 for a standard customer. Private clients pay $0. And then add the mortgage rate discount. Even a 0.25% reduction on a 30-year loan of $350,000 saves you roughly $18,000 over the life of that mortgage. The math at this level starts compounding in your favor fast. The bank is no longer taking from you, it's giving back to you. Here's what's powerful about this first level. It's reachable. Most people hearing this right now could get here within 3 to 7 years with disciplined saving and investing. You don't need a 6-figure salary. You need a plan and consistency. And once you arrive, the bank stops treating you as a transaction and starts treating you as a relationship. But here's the thing most people miss. These benefits don't show up automatically. You often have to enroll in the program. You have to ask. The bank isn't going to call you up and say, "Hey, you qualify for lower rates now." You have to know the game exists before you can play it. So, take this as your invitation. If your balances are in this range, call your bank this week. Ask what programs you qualify for. You might be shocked at what's already available to you that you've never been offered. Now, let's talk about the second level. And this is where things get serious. We're looking at $500,000 to $1 million in investable assets. $500,000 to $1 million liquid. At this level, you cross a line that the banking industry calls high net worth. And when you become a high net worth client, the dynamic flips. You are no longer chasing the bank. The bank starts chasing you. Here's why. When you have $500,000 or more parked with a financial institution, you represent significant revenue to them. They earn money by lending out your deposits. They earn fees from managing your investments. They make money when you take out loans against your own assets. You become a profit engine, and they know it. So they compete for your attention. At this level, banks start offering you something called a portfolio line of credit, sometimes called a securities-based line of credit, or S-block. This means you can borrow against your investment portfolio without selling a single share. Think about that for a second. You own $700,000 in stocks and bonds. Instead of selling and triggering a tax event, you borrow $200,000 against those assets at a rate that's often lower than a traditional mortgage. You keep your investments growing, you avoid capital gains taxes, and you get access to cash when you need it. This is actually the core of what the ultra-wealthy call the buy, borrow, die strategy. Step 1. You buy appreciating assets like stocks and real estate. Step 2. Instead of selling those assets to fund your life, you borrow against them. Loans aren't taxable income, so you pay no capital gains tax. Your assets keep growing while you spend the borrowed money. Step 3. When you pass away, your heirs receive those assets with a stepped-up cost basis, which means the unrealized gains are essentially wiped clean for tax purposes. The loan gets repaid from the estate, and your family keeps the wealth. This is a tool that wealthy people use constantly, and most regular banking customers have never even heard of it. And it starts becoming available to you right here, at this second tier. You also get access to preferential mortgage rates that go far beyond the standard discount. Banks at this level will structure custom lending packages. Need a jumbo loan above the conforming limit? They'll put together terms you won't find on any rate comparison website. Need bridge financing to buy a new house before selling your old one? They make it happen with a phone call. The investment side opens up too. At this tier, you gain access to alternative investments, private equity funds, hedge fund allocations, pre-IPO deals, real estate syndications that aren't available to the general public. These are the types of investments that can generate 12%, 15%, even 20% annual returns, and the bank puts them on the table because you now meet the minimums. Something else changes at this level that nobody talks about. Your banker becomes your advocate inside the institution. If a fee gets charged, it gets reversed. If a wire transfer has an issue, it's handled immediately. If you need an exception to a policy, your banker goes to bat for you. You're no longer a number in a system. You have a name and a face inside that building. Bank of America's Diamond tier kicks in at $1 million. That gets you everything in the lower tiers, plus a 100% bonus on credit card rewards, meaning that same 1.5% cashback card now earns 3% on everything. At Chase, crossing into the J.P. Morgan private client tier with $750,000 to $1 million in qualifying balances puts you in a different universe of banking entirely. You get a dedicated J.P. Morgan advisor. You get comprehensive financial planning, estate planning, and tax optimization strategies. Morgan Stanley, at its reserved tier, requires $2 million in eligible household assets. And at that level, you're getting institutional-grade portfolio management and pricing that retail clients will never see. And here's a critical point about FDIC insurance at this level. The standard FDIC limit is $250,000 per depositor, per bank, per ownership category. When your deposits exceed that, the bank will actually help you structure your accounts to maximize your coverage. Joint accounts, trust accounts, different ownership categories. They'll set it up so that a couple could have over $1 million fully insured at a single institution. Regular customers don't even know this is possible. They just assume their money above $250,000 isn't protected. But at this tier, the bank shows you the playbook. Getting to this second level is where most people's financial lives change permanently. It's the difference between managing money and having money managed for you. And the compound effect at this level is staggering, because the tools, rates, and access you receive actually accelerate your wealth building. The rich don't just have more money, they have better tools. This is where those tools get handed to you. Now, let's get into the third level. This is the $10 million and above club, ultra-high net worth. And at this level, banking as you understand it ceases to exist. At $10 million in liquid investable assets, you qualify for true private banking at institutions like J.P. Morgan Private Bank, Citi Private Bank, Goldman Sachs Private Wealth Management, UBS, and Morgan Stanley Private Wealth Management. A private banker is assigned to you, and that person doesn't handle 500 clients. They might manage 30 to 50 families. You have their direct cell phone number. They know your kids' names. They know when your tax deadlines are. They know your estate plan inside and out. At Citi Private Bank, the net worth requirement is $10 million minimum. Goldman Sachs Private Wealth Management also requires $10 million and charges management fees between 0.75% and 2.25%, depending on services. UBS requires $2 million for its private banking entry, but its most exclusive tier starts at $10 million. And these aren't marketing gimmicks. These firms dedicate serious resources to each client. You get a full team, including an investment advisor, a lending specialist, a trust and estate attorney, and sometimes even a concierge for non-financial needs. And when I say concierge, I don't mean someone who books you a dinner reservation. At this level, banks and family office services provide lifestyle management. They coordinate household staff, They arrange private travel. They handle art acquisitions and insurance. They manage cybersecurity assessments for your family. RBC Wealth Management recently expanded its ultra-high net worth platform to include art advisory services, bespoke travel concierge, bill pay management, and even personal security consulting. Your bank becomes a partner in managing your entire life, not just your portfolio. The lending at this level is unlike anything most people can imagine. Want to buy a $15 million property? Your private bank can structure the entire deal in-house, with terms customized to your cash flow and tax situation. Want a line of credit for $5 million at rates lower than what most people pay on a car loan? Done. At this level, banks are competing so aggressively for your relationship that interest rates, fees, and terms become almost entirely negotiable. Everything is a conversation, and the buy, borrow, die strategy we talked about earlier, at this tier, it's not just a concept, it's your entire financial architecture. Your private bank builds it, manages it, and optimizes it for you across generations. On the investment side, you get access to deals that are completely invisible to the public. Direct private equity co-investments, meaning you invest alongside the fund into a specific company. Venture capital allocations at the ground floor. Commercial real estate deals. International opportunities. Art and collectible lending. You're not buying an index fund anymore. You're building a portfolio that looks like a family office. Goldman Sachs, for example, has over $2.5 trillion in assets under management, and their private wealth clients get access to the same deal flow that institutional investors see. But the most powerful benefit at this level isn't even financial. It's the network. When you're a client at a top-tier private bank, they connect you with other clients. They host exclusive dinners, investment forums, and private events where the people in the room have a combined net worth in the billions. These rooms are where partnerships form, where deals happen, where your next business opportunity comes from a handshake, not a cold email. The bank becomes your network hub. And in business and wealth building, access to the right room at the right time is worth more than any investment return. And here's one more thing about this level that will shift how you think about the entire system. At $10 million and above, banks don't just manage your money during your lifetime. They help you build multi-generational wealth. Trust structures that pass assets to your children and grandchildren while minimizing estate taxes. Charitable vehicles like donor-advised funds and private foundations that let you give strategically while getting tax benefits. Succession planning for businesses. Legacy planning that ensures your wealth survives you by decades. At this tier, the conversation shifts from, "How do I grow my money?" to, "How do I make sure my family never has to worry about money again?" Here's what I want you to take away from this. Every dollar you save and invest doesn't just add to your net worth. It moves you closer to a tier where the entire financial system starts working in your favor. The fees shrink, the rates drop, the doors open, and the speed at which your wealth compounds increases dramatically. That's why the first $100,000 is the hardest, and why Charlie Munger was right when he said, the first $100,000 is a bear, but you've got to do it. Because once you cross that line, the rules start changing. And by the time you hit $500,000, the rules have changed so much that your money is making money in ways you didn't even know were possible. You don't need to be there tomorrow, but you need to know where the finish lines are. Because once you cross them, doors open that you didn't even know existed. And the banks that were once profiting off your fees will be competing to hand you their best tools, their best rates, and their best people. If this is the kind of straight-talk financial content you've been looking for, hit that subscribe button right now. Thanks for watching, and I'll see you in the next one.